You just want to manage your costs, manage your occupancy, and have consistency as much as possible because you're getting hit every which way on the other side of your book. So let's try to do what we can on the operating side. And yeah, we're going to get killed on the capital financing side, but hey, let's try to solve one problem at a time.
Welcome to Real Estate Hustlers Podcast. I am your host, Josh Appleman, founder and CEO of Appleman Properties. Today we are joined with Omar Khan, founder of Boardwalk Wealth, has overseen $3.7 billion in capital financing and $250 million in multifamily real estate. Third generation investor and CFA charter holder. He specializes in deal sourcing, investor relations, and asset management. Omar, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Hi, man. Thanks for having me. As you know, Josh told you, my name is Omar Khan. I'm the founder of Boardwalk Wealth. We both acquire as well as develop multifamily properties across the Southeast and Midwest. We've transacted now on close to I think it's $580 million. So maybe you got an outdated bio for us of transactions, multifamily across these geographies. I live in Dallas, wife, 2 sons. Life is good most days. Sometimes, with all the rates going up, it's not as good. But otherwise, we work with high net worth, high income entrepreneurs and professionals. And yeah, happy to answer any questions and glad you invited me.
Let's start with the very beginning. How did you get started in real estate, and then what led you to where you're at right now?
Well, when I moved here from Canada, gosh, it was like 2015, 2016, something like that. I'd already worked in investment banking. I'd already worked on the corporate side. So I had a good set of experiences running and structuring deals and a good network. And, I was roughly about 29, 30, maybe something like that, right? And it was the right time, right place, right? My family is a business family anyway, so I eventually knew I wanted to do something business-oriented. And I joke with people and say, I like making money and I hate paying taxes. Real estate seemed to be a pretty easy way up in that regard.
That's very true. That's very true. So you were brought up in the environment. It was something you grew up with, and seeing your family around investing and business ownership, the entrepreneurial world. It was nothing new to you.
Yeah, but I mean, doing it by yourself, taking that plunge, all of that. Obviously, I didn't have any family help or anything of the sort. So technically, should I have done this a long time ago? Yeah, maybe. But could have, would have, should have, right? I mean, that sort of thing. Doing it by yourself is a way different ballgame than having an uncle or a father or somebody that does it, right?
Yeah. Especially you're going out there, you're taking your own risk, and it's sink or swim. So yeah, I totally get that, and ultimately you make your own decisions the best you can. A decision has to be made, and just hope that it works out. And 9 times out of 10, hopefully it does. When you're underwriting deals, what markets are you looking for, and then what kind of risk return profile are you looking for?
Look, typically we are in the Southeast, so Atlanta or Jacksonville, Orlando, and surrounding markets. And in developments, we're in the Midwest, primarily Sioux Falls, South Dakota. The profile of resident we're looking at is typically middle class to upper middle class. Average incomes at least like 60 to 70,000 minimum. There's potentially the submarket has at least schools that are rated 6 or 7 or higher, because we feel school districts are good. They're not a perfect barometer, but they're a very good barometer of the type of resident you're going to get. And we are basically concentrated on acquisition side on the B type properties, and development is obviously A, right? Because you're building from the ground up. So that's roughly the business model. Now, obviously, there are certain exceptions because, as you get to learn about the markets, you understand which part of the market is better, which part of the market is, not as nice for your type of business plan. But high level, that's kind of where we are and what we do.
Got it. Steady areas that are predictable. Past performance will most likely equal future results.
Well, we hope so, but with the way the rates have risen up violently, right? That's something nobody underwrote for, and if they tell you, they're a magician probably. So, performance, underlying operating performance is good by the grace of God, but we're all getting killed with the rates and where things are going. Even deals which have fixed rates, the problem becomes, if you ever want to refinance those deals, well, I mean, it's a night and day difference, right? Where rates were even 2 years ago and where they are now.
Yeah, it's we've got a couple deals that are due. We can go on extension or refinance, whether it's agency or other source. But we're in interest only. We like where we're at, but it's hard to determine which direction we want to take it.
Yeah, look, and I mean, there's a lot of stress in the market. So the whole deal now is survival for a lot of folks.
Yeah.
Luckily, not all of our deals are there. I think maybe a one deal out of like 15, but still, you feel the pain and you realize when you talk to your friends, somebody might have 50, 80% of their portfolio that's stressed,
Yeah.
right? So it's a tough time for everyone, basically, in the market.
Yeah, thankfully we're in a fixed rate. A lot of there's groups out there that don't have rate caps and they're getting hammered. I mean, just their payments are just going through the roof because the rates are going through the roof. So it's
Yeah, look, I mean, if you're a serial acquirer, like if you're acquiring 100, $200 million a year at the minimum, you were, I don't care what somebody says, they were all doing floating rate debt.
yeah,
Because I mean, look, if you're doing smaller deals or maybe you're not doing that much volume, yeah, you can do the fixed rate game all day long. But if you're serially acquiring, you're doing 100, 200 minimum volume, million volume a year. So that's at least like 3, 4, 5 transactions, right? At least 25, $30 million transactions. Floating rate exposure is what you have on your book. It's a big pain in the butt, but I mean,
yeah.
that it is what it is, basically.
Are you so? I mean, there's ways of hedging, but there's other ways you just can't get away from it. Are you all trying to? Of course, you're trying to push rent collections and everything else. But what are some other hedges to what groups are coming up against with your negative cash
Capital
flow?
calls, we haven't done any, but I know a lot of groups are doing capital calls. And there's one interesting group, I'm not going to take their name. They called it something else. I don't know what they called it. They called it something interesting. And then when an investor said, well, that's basically a capital call, they're like, whoa, 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 whoa. We didn't say capital call. They're like, dude, it's the exact same thing,
Yeah,
right? So, no, capital call is across the board. I feel a lot of people think capital call is somehow evil or bad. I mean, again, we haven't done it, but sometimes you need it, right? I mean, look,
yeah,
that's the game you're playing. If you want to make 18, 20, 25, 30% a year in returns, well, there are going to be times where you have some downtimes. I mean, trees don't grow to the sky forever. So a lot of groups that I've heard of are doing capital calls. They're recapitalizing deals by bringing in either preferred equity or some version of that, or GPs are lending money to their deals. That's far few and far in between. Uh, yeah,
I know we use Invest Next portal, and there's a new button that says capital call at the top now. So a new feature was added.
oh, are you serious? Because we use
Yeah,
InvestX, but I don't ever go in there. I have my team that does all the
yeah.
stuff there. Oh wow, okay, I gotta look at that, man.
Yeah, so
Holy
it's
moly, I didn't even
just
know that.
just released a few weeks ago, so it's definitely interesting to see that pop up, and it's just that's kind of tells you the times, what's going on, and then also
Oh my
you
God,
just
hold on. You know what? I'm sorry, I've never done this on a podcast before. I am actually going to message my team right now. Hey,
yeah
do you know that InvestNext has a capital call button that just
yes
level?
they just incorporate that into the platform, so it's a it kind of tells you the times of what groups are up against, which you're recapitalizing the property to get to another stage of the economic conditions, whether that's
Jeez, man, holy crap. Where is that actually? Now I'm actually really interested. Where is
yeah,
it?
it was right there up at the top. I can I'll log in here in a little while,
Yes,
but
send it to me, man. Wow, that is okay. I said I haven't even logged into this portal in forever. Oh, well, does it say capital calls? Is
uh
it capital calls?
yeah, yeah. Let me see here.
Oh, yeah, I'm seeing this now. I haven't logged to like this. Oh, Eric just messaged me. I've known this for months. Thanks for sharing the news. Okay,
Yeah,
wow, dude, geez, that's wow, I
right
didn't
there
even know.
under projects. But see, the feature was just rolled out fully, so maybe he had early access. But yeah, it's just, and I'm sure other platforms are the same. There's quite a few out there, but it just kind of goes to show. And then you had mentioned insurance costs, like that's another
Yeah.
huge swing that you cannot underwrite. And you had no idea that that's even coming down
Oh,
the
by the
path.
way, nobody does. By the way, we're talking groups like Blackstone, KKRs, Apollos, Brookfield. These are the biggest, brightest, big 900-pound gorillas.
Yeah,
Even there in their reports, they are literally saying, as an example, like I know guys in Florida, we have one asset, and thankfully, by the grace of God, our insurance only went up by like 15 or 17%, something like that.
yeah,
And we thought we dodged a freaking bullet, like literally. I know guys where their insurance has gone up from like $500, $600, $700 a unit to like over $2,800 a
Yeah.
unit, like that, in less than a year.
You can't do anything about it. There's no hedging that, and you're bound by the lender to have certain insurance constraints. So what do you do? you,
No,
you
because
guys
look, again, this is like early this year when these had happened, but it was the first wave of this happening, right? I was talking to a broker out of Tampa, and Tampa's right on that like coast where there's a few hurricanes going, so they're even more sensitive there. And this is at the time when rates had gone from like 600-700 to about 12-ish hundred, 1,100, something like that for Class A properties.
Yeah.
And what he was telling me is right now, any deals that I'm selling, they've immediately had $10,000 to $15,000 per unit as a price gone down just by this shooting up from $600-700 to $1,200. And this is Class A product. Think about it that way, right?
Wow.
So if you're B or C, it's even worse. So now if it's gone up from $1,200 to $2,500, think about, I mean, you could have been doing everything right. Got the right debt, you are operating at a world-class level, $30,000 of value per unit. $30,000 of value is just evaporated.
Yeah. Even if you got a home run deal, a deal of a lifetime, it could just been totally blown by the insurance.
You could have like a 4% fixed rate, interest rate, whatever, 12-year agency loan.
Yeah.
You're still underwater.
Yeah. Yeah.
It's the same in Texas, by the way. I don't know where do you live? Do you live in Texas?
No, I'm in Cincinnati area. So we're steady Betty. Our insurance, I mean, we're talking 150, 250 per unit. So we're on different worlds, different plans.
Yeah, but even in Texas, man, I know lots of my friends that are actually very thoughtful, very good operators. Yeah. I've actually invested with them as well, and they're just getting slaughtered right now.
Yeah. Yeah. We just put an offer in on a property down in New Orleans, and it's $400,000 per year on insurance, and we're hoping to be able to bring it down. We think we can, but there's opportunities.
But New Orleans also has a crime issue, I've heard, and all. I mean, it's a great place to visit, but it has crime issues, demographic issues.
You've got to be in the right place. Yeah.
It's very pocketed, basically,
street by street, and I say that is truly what it is. How are you all structuring? What does your capital stack look like typically?
So capital stack is very simple. We have got common equity and senior loans for most of our deals. And we prefer to keep it that way because, again, I'm coming from the investment banking world where people are paid to make things complicated. Yeah. And the problem there becomes in the good time, the more complication you have, you look like a genius, like an Oz sort of figure behind the curtain. The problem is in the bad times or when things go sideways, unraveling all of that becomes a pain, basically. So we like to keep, so far at least, we like to keep things simple, no fancy exotic structures, no fancy exotic instruments. But yeah, I mean, that might be a preference for simplicity more than anything else.
Yeah, I think the mezz that can come in and create a lot of different pain points and different, like the environment we're in right now. If you had some mezz in there, it would be just fumbling through it because they go off of course, NOI and DSCR, and then they want to take the keys over at any chance they can.
Yeah, but the issue there is, look, man, for about 5, 10, 15 years, however long it was, people made so much money by having those things that they thought, they're just walking on water.
Yeah.
Sort of deal.
For sure. Yeah, absolutely. Well, they had access to institutional vehicles for sure. What are you all doing on your properties to, I say this maybe not within the times, but typically what would you all do to boost the NOI, to compress your expenses and maybe add-ons to
Josh, look, you have to understand a lot of the stress, or pretty much all the stress we're facing, say 90% of the stress, is capital markets related.
Yeah.
So right now, as an example, if you're in any of, again, I don't know about Cincinnati, but if you're in any of the southeastern markets, or even say Phoenixes and all those places that were super hot and darlings, right? You have no rent growth. Okay, I don't care what somebody tells you. I don't care what a syndicator says that they're going to come in, do their super premium platinum package and get $500 extra in rent. That shit is not happening. Okay, so the thing that is happening right now, across the board, by the way, right, is occupancy management. Because think about it this way: if you have one person leaving, you got to turn over the unit, do repairs and maintenance. You got to process whoever's the new resident there, that's admin costs, advertising costs. Across the board, you have more costs. So the average, if somebody leaves, the average dollars and not to mention the lost rent for a couple of weeks minimum, right?
Yeah.
It turns out to be at least $2,000 to $4,000 minimum, like just the cost of somebody leaving. So now think about it this way: if it's $2,000, and this is at the low end, right? If you're only going to be making an extra $200 a month, if at all, right? Well, you're giving up $2,000 and making $400 on top, because 200 times 12 is 2,400, right? And that's a big if, by the way, because you might not get it. So earlier it was like, yeah, you'll spend 2,000, but you're getting $500 a month extra in rent. So 12 times 5 is 6,000. That spread is so big that you're like, ah, screw it. I'll take the $2,000 hit right now, get the $6,000 here. Now it's all occupancy management. I don't care what a syndicator tells me, either they're delusional or they're lying. You have to push your occupancies highs up. You got to get your renewal percentages as high as possible, even more than usual, because what you're trying to do is, the rent growth isn't there. It's not like the next guy's going to come in and pay you a lot. Right. So you just want to manage your costs, manage your occupancy, and have consistency as much as possible, because you're getting hit every which way on the other side of your book. So let's try to do what we can on the operating side. And yeah, we're going to get killed on the capital financing side, but hey, let's try to solve one problem at a time.
Yeah, I mean, well, your operation side, if you're keeping occupied and keeping tenants paying their rent on time or close to it, then I mean that definitely helps helps offset the.
Yeah, and look, all the usual stuff about developing communities, screening tenants the right way, that's there. But in times of stress, you're going to have a lot of residents that either don't want to pay, or if they're on that gravy train of the government's going to pay everything for me, well, you can't change that mentality, basically.
Yeah, no, I totally agree 100%. And it is they're managing the rent roll and managing the bad actors. I mean, it's when you have economies of scale, you can kind of, certain numbers can come out and poke at you. How are you all managing like KPIs? What are you looking at for different indicators of how your properties are doing?
So right now it's occupancy delinquency management, and basically on the CapEx side, what we're trying to do is spend as little as possible, but to break even. Right? That's what we're trying to do.
Yeah.
So those are look, there we have an extensive dashboard. We track cash flows, all of that. But high level wise, it's occupancy delinquency first, and then trying to see, okay, how much CapEx, and how much, I mean how little, we have to spend to retain this person, not have any disruptions in the workflow.
So are you all are third party, correct?
Yeah, I just work with one third party. I have a small ownership stake in them, but I let them do all the work.
But you can push as hard as you need to push to get things done, I'm sure.
Oh, yeah. Plus, look, on our side, we have 10, 11 employees anyways on the corporate side. So we have operations people, accounting people, all of that stuff. So they're in day-to-day touch with the property manager anyways. We're not waiting for the end of the month. You get a report, you kind of have whatever your session. Every day, pretty much, we're blocking and tackling with the property manager.
Yeah. Give us some wins. What are some big wins that you've had in your career?
Look, wins are, as much as we're stressed and as much as this current time sucks for a lot of serial acquirers and developers, right? Look, this is also, by the grace of God, this is also a very good business. It's been very good to us, right? So we're just looking at right now and being like, oh my God, the world's ending. Well, we've also made a lot of money. It's like, how it says in the good book, you have 7 years of feast and 7 years of famine. Well, unfortunately, we're in the first year of the famine. So when you're fat, getting thin is the end of the freaking world. In fact, I had one broker actually from Atlanta tell me, he's like, man, I think I had forgotten how to underwrite, because for the past 4 years, all I was doing was pushing out a deal and we'd get like 20 offers. And he's like, now people ask me questions. I'm like, oh, we didn't do that. We didn't do this. And he's like, I just have to train myself. So look, we've sold a lot of transactions, made investors a lot of money. So far, at least by the grace of God, I think with the exception of one deal, every other deal we're whole on our debt, and we have enough term left on our debt as well, right? So while there's going to be hiccups along the way, hopefully not a lot, but I'm very upfront about these things, right? If people try to hide and say, oh, no, because this is a joke I have with my team. If you ever look at any real estate interview, they'll be like, oh yeah, the whole market is under stress. We're fine. We're cool, man. I'm walking on water. That's not the case. Everybody's under stress. Thankfully, we have some term left on our debt for most of our properties if they're not long-term. So hopefully we can ride out the storm. But the whole factor here is, look, we've sold a lot of deals, made a lot of money for people. We're doing our best. We have a process in place that protects investors' capital. And you're going to have a time that's a trough before you go back to the peak again.
Yeah. Well, and it's alternative assets, but I mean, you look at the stock market, and I mean, it's it's a slaughter, or it's like, wow, 400-point swing. It's incredible the amount of emotional distress that one could take through on just watching their stocks go up and down.
Yeah, I mean, look, my point is, trees don't grow to the sky forever. Money doesn't grow, and money definitely doesn't grow on trees. So if you want 18, 20, 25% returns, which people have been getting, well, then there's going to be some times, unfortunately, look, nobody wants to be the bearer of bad news. But unfortunately, there are going to be instances where that strategy is going to be tested.
Yeah.
And that's just the way it is. That's investing, right? It's not a guarantee.
I think it's going to be like the year of the operator. Like finally, the operators.
That's what I said, my friend. That's what I said. I have a famous video about that. It's the year of the operator, and now you're going to truly find out who's swimming naked, basically.
Yeah. Well, in just being a business owner, being able to pivot and make countermeasures rapidly. It's that's being in business, and yeah, we'll see. What about deal flow? Are you all looking for distressed deals, opportunities coming down the pipe to capture some of those?
I can tell you this, that all this hoopla that you're hearing about distressed deals, if there are, the issue is that those deals are so shitty to begin with that you're touching radioactive waste, basically.
That's a nice way to put it. Yeah.
Right. So the point is, yeah, it's distressed, but it's distressed for a reason. Right. So right now we're seeing a lot of that. Again, I'm only talking about the markets I'm in, right? Every market is kind of different. So as much as I'd like to do more acquisitions, because acquisitions, I really don't have to use my brain. We've got a playbook. We implemented boom, 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 boom. Right. We have done only developments this year. The reason why we're doing developments is we've got a big pipeline. We're active, but developments require more work from us. Right? You can make more money. So we're not looking at any acquisitions. We get it. We bid on it, not finding any juicy returns. But when I talk to brokers in Texas, Georgia, Florida, even in the Midwest, they are guiding towards, say, more distress coming in Q1 and Q2 and, so on and so forth. But the problem there is going to be that a lot of deals that are becoming available or will become available, say, in 6 months, a year's time, they are not going to be financeable using your usual lending sources. Right. So if they're not financeable, and then raising equity is going to be very hard for a lot of folks. So if you're doing your typical 15, 20, $30 million deal, and earlier you needed $4 or $5 million to close on a $20 million deal, now you're going to need $9 or $10 million.
Yeah.
So people, even if the deal is very good, a lot of folks might not be able to have the money there ready. So we're looking at distress. A lot of this is in areas we were never going to go to begin with, but the distress that is potentially coming, right? It's a mixed bag. Number one, it's a bit of shitty deals, good deals, whatever. But even in that instances, how do you get it financed? Yeah. That's the problem.
Yeah, bringing everything together.
Yeah.
What about the supply that's coming online? I mean, there's a ton being built. You're building. What are your thoughts on new supply coming online mixed in with the existing, or is that going to counteract the occupancy rates and performance? What are your thoughts?
Look, so if you're in the B-ish space, it depends what market you're in. So I know a lot of folks in Austin. I live in Dallas, and lots of folks in Austin, and a couple of guys in Tampa, and Phoenix as well. Phoenix, definitely, right? These three cities are the poster children for a glut of supply hitting the market. Also Huntsville, Alabama, weirdly, right? They have like double-digit. The new supply coming in is double-digit, like 10, 15, 17% of the total supply of the market. So that's already causing a lot of issues in terms of rent growth and occupancy management, because somebody that was paying a B rent can pay $50 more and get a concession into an A-class property. That's pushing up some issues there. But the problem overall we're seeing is that most of the submarkets we're in, we don't have a supply issue. What we have basically is a financing issue right now. Like rates are so high that that's causing more stress than the actual supply coming online, basically.
Yeah. And then alternatively, you have to charge more rents in order to offset the new cost. But then there's only
you can, but there's only so much rent you can charge.
There's only so much. Yeah. There's a ceiling, and when that breaks, it's.
And look, if anything, right now you are not being able to charge more rents. In most markets, rent growth has stalled to being negative. So you're lucky if you were getting a rent from 3 to 6 months ago. That's just the truth in the Southeast markets right now. Right? So you're not even thinking about pushing rents. You're thinking about pushing up occupancy. Yeah, and I don't care what somebody says about how much renovations they're doing and their super duper ultra premium package that they're going to put in, which is basically a new countertop right?
Right.
Basically, new lights, new countertops, and I'm going to change the color from white to gray. Great.
Right.
People are going
Yeah.
to pay me more money.
Yeah, we're definitely underwriting zero rent increases within the
Yeah.
next 3 years, just to stabilize what we have. There's probably going to be we know where the plateau is, we know it can dip, and then you've got new supply, so then you've got concessions. So there's just a lot that is hitting the markets all at once, and it's kind of we don't have a settling period yet. So where are you heading? What's the overall arching plan with say next to 3 to 5 years?
Well, I don't know about 3 to 5 years. The overarching plan for the next year is on existing acquisitions, find a way to get to like 2025 in middle, right? Continue cycling, continuing the things, right? Continuing putting our processes, systems in place. And again, it's one thing to have processes, it's one thing to do it, right? It's a bit like going to the gym, right? And I'm guilty of this, by the way. I go to the gym for a month and then I don't go for 3 months. So it's continuing to do all of that stuff on the development side, fully maturing out our pipeline because we get like 3 5 year fixed rate debt. So that's really good. And we deliver in about a year and a half. So that's a really good business model to be in. And then selectively looking at opportunities, basically. But again, those are few and far in between.
Got it. For someone wanting to get into real estate and kind of learn the path of which one to take, whether it's buying their own real estate or being a part of the LP or GP, how would you tell them to go about their journey?
Well, I would tell them first of all to figure out what lane they want to be in, right? Look, if you have a job and you can't do like 15 things, right? I know all these gurus online will tell you, oh, passive this and passive that. First of all, there is no passive investing also. If you're not vetting the people, you're not finding the right relationships, yeah, you can give your money to some jackass and they're going to lose all of it,
Right.
right? So you have to first of all figure out, well, how much time do you have to spend? Can you spend this? Because if you're, say, in a corporate career, and I know everybody likes to shit on jobs, oh, it's a job. A lot of those people happen to be people who make like 50 to 80,000 a year. No offense, but you're not making a lot of money anyways to be shitting on jobs. A lot of folks that we know make 300, 500, 800,000 dollars a year, maybe $1 million a year in their jobs.
Yeah.
Well, kind of hard to leave that job when you're making $500,000 or $300,000 versus somebody who's making $80,000 and is 45 years old, right? So if you're in a high income profession, I would suggest sticking there because it's going to make a shit ton of money. That's going to be your wealth generator. And then picking the right spots to basically ease yourself into it. But look, if you want to make it a career, I would suggest partnering with the right people, even working for top tier firms. I know everybody wants to start their own business, but if you don't have all the building blocks in place, you could be in for rough times.
Yeah. What would be a book that you would recommend somebody to pick up and read?
Oh, there's lots of books, man. You could like read Peter Linneman's book. It's a textbook, so I know it's going to be boring, but if you want to learn about the business, he's got a. Well, let me look it up. Peter, what is it? I have this text. Yeah, real estate, finance, and investments, risks and opportunities. Okay, it's a classic textbook. It's a seminal textbook. It'll teach you pretty much the ins and outs of everything, right? Real estate wise, and then after that, look, you do learn by doing. Basically, it's a bit like you can't learn how to ride a bike by reading a book. You kind of have to get on the bike.
Yeah, take action.
Right?
Absolutely.
Yeah.
If somebody wants to reach out, get a hold of you, and learn more about yourself and your company, how can they get a hold of you?
Look, you can join on my mailing list by going to my company's website, boardwalkwealth.com. The form is right on the homepage. Again, that's at boardwalkwealth.com.
That's perfect. Omar, we definitely appreciate you coming on today, and I look forward to following you and watching you grow.
Thank you, Josh. Really appreciate it. Have a
Thank you.
good one.
You too.
Bye.